Hi, everybody. This is David Rowe with Highland Capital Advisors, and Nicole Franson asked me to provide a virtual brief review of the Central Washington Catholic Foundation Endowment. So I'm going to share my screen here, and let's get to it. So for a quick overview of the endowment, for the first calendar quarter of 2023, which is the third fiscal quarter, for the fiscal year beginning July 1, 2022, investors enjoyed some much welcome relief with markets being strong and the momentum from fourth quarter of 2022 continuing into 2023. At the beginning of the year, with the strong fourth quarter results from last year, the endowment was back above $5 million at the beginning of January 1, 2023. We had positive net flows. Donations continued to be strong as they roll in throughout the year. We had some distributions that were residual from the fall payout, and the endowment enjoyed just over $300,000 in total return for the quarter ending March 31, 2023, bringing assets, total endowment assets, to just below 5.3 million at the end of the quarter. If we translate that into a rate of return, down on the bottom here, you see that purple bar. That represents a return of 6.1%. And the policy benchmark, the black bar right next to it, is 5%. So we had some outperformance for this quarter. It doesn't always happen to be that way, but it's always nice to see some outperformance from time to time. This memorandum that I'm showing you on the screen right now is something that is published by Highland Capital Advisors each quarter. And it's a brief overview on the front page. And then on the second page, we provide a detailed breakdown of each endowment fund with cash flows for the quarter, net gain, and ending balance. If you're curious why some of the group numbers include a Q, those are quasi-endowments. Rather than being permanently restricted through a donor designation or permanent restriction, these are board-designated endowments. And so while there's every intention of them being permanently restricted, it is legally possible that the board could change its mind, and that's why they have a suffix of Q for quasi-endowment. I'm going to move into a quarterly return. We go through a chart of the quarter just to provide some additional perspective on markets and various other investment topics. Last year, 2022, was a very challenging year with interest rates increasing rapidly by the Fed. And there were a number of investment experts and others in the industry that were suggesting that the classic balanced portfolio, or a moderate portfolio of 60% equities and 40% bonds, was out of date, out of touch, irrelevant, dead, whatever negative adjective you want to use. And usually those white papers or stories were followed up with a product pitch. So it's kind of clear how sometimes people's motivations are measured. But based on some Morningstar research and research that Highland Capital conducted, we wanted to ask the question, just how valid or relevant is a 60-40 portfolio? Long story short, very valid, very reasonable. And here's some evidence. So if we look at tactical fund managers, these are managers that have the ability to adjust their stock bond cash mix depending on the economic winds. This is a chart that shows the 10-year track record for tactical fund managers dating back to it dates back to December 31, 2022, and the 10-year track record would then start December 31 of 2012. At that point in time, there were 359 funds registered as tactical funds. Again, these are funds where the manager can overweight stocks, underweight stocks, move into bonds, move into international equities. I mean, you name it. They're trying to time the market based on all of their expertise, boots on the ground, analyst teams, and what have you. Well, while there were roughly 360 fund managers 10 years ago, if we adjust for redundant share classes, that list whittles down to 132 actual strategies that were investable. But after 10 years of time, as of December 31, 2022, there were only 48 funds left. Nearly 2/3 of those strategies failed to succeed and they just flat out went away. So what does this chart represent? All those blue lines represents the 48 surviving funds that could adjust their asset allocation based on which way economic trends were going. All but one, fortunately, had a positive return over that 10-year period of time. One had a negative return over a 10-year period of time. But interestingly, none of those strategies beat a simple 60-40 mix of index funds held to a strategic allocation of 60% equities and 40% fixed income. I'm not going to say that every trailing 10-year period of time, a 60-40 mix is going to win, but at least through December 31, 2022, a 60-40 fund appears to be as relevant as ever, especially considering that it took the brunt, just like all these other strategies, of a very challenging rate environment for fixed income investors in 2022. Moral of the story is, if smart people can't beat a 60-40 index, what makes us think that we can? We adhered to a strategic asset allocation approach at Highland Capital, and this approach is in force within the Central Washington Catholic Foundation Endowment. Let's move to the investment review. Just to provide a little more perspective on the markets, if we look at the first quarter of 2023 down here in the lower right, we can see that these color-coded rectangles, we call this the periodic chart of market returns. The legend for the key is up here on the top left, but we see that right on down the line for the quarter, every single asset class had a positive return except that red rectangle there at the bottom, negative 5.4%. That's commodities. The leader for this go around was international developed stocks, posting a return of 8.5%. U.S. large cap equity posted a return of 7.5%. And despite the fact that the Fed is raising rates on the very short end of the curve, the entire yield curve, 5-year maturities, 10, 20, 30-year maturities, the yield curve dropped. And as a result, long bonds benefited from that shift in the yield curve, posted a return of 5.8%. Many are attributing the returns to continued improvement in inflation, a tapering of the Fed rate hikes. Most of the rate hikes in 2022 were near 0.5%. This year, they've been half of that at 0.25% or 25 basis points. Consumer spending was strong during the first quarter of 2023, and unemployment remains low. So there are signs of positive economic activity. There's certainly talks of recession, and inflation is the Fed has made it very clear that inflation is their primary concern, and it may take a recession to help get inflation under control. Time will tell. So if we go back to some plan information, this is the dashboard for the Central Washington Catholic Foundation Endowment. I went through some of this material before on that memo summary. You'll see some subtle differences on this page because this is coming from our performance reporting system. Data is gathered slightly different, and actually the returns in this report are more precise because we have gathered information and cash flows on a monthly basis for these return calculations. So on that basis, for the quarter, the endowment posted a return of 6.5% relative to a policy benchmark of 5.2%. Fiscal year to date, this would be July 1, 2022 through March 31, 2023. It's a 9-month period. Total return of 7.4%. So that's an outstanding result fiscal year to date so far. And despite the dismal results in 2022, the 1-year results have clawed back considerably, and the endowment is only down just under 4.5% on a 1-year period. When we look at the 3, 5, and 10-year results, 3-year numbers at 10.5%, spectacular, largely driven by some of the outlandish returns we saw from the pandemic era. When we look at the 5 and 10-year results, these are certainly more in line with what we would expect this investment policy to generate, 5.7 and 6% on a 10-year basis. You can see the policy benchmark composition in the top middle tile here. We can see that the Central Washington Catholic Foundation is closely aligned with that. Right now, fixed income investments are slightly underweight, about 2% below its absolute target, and foreign large stocks are about 2.5% above absolute targets, but this is well within the lower and upper limits. And so we are closely aligned and will maintain that compass bearing with regard to the portfolio. I'm going to go through and jump to what we call a watch list mechanism, because I think this is important to see. And yeah, so each quarter we evaluate each manager, ensuring that they're adding value, particularly if they're an active manager. An active manager is seeking to beat the fund's benchmark, whereas a passive or index manager is seeking to track the benchmark, or the benchmark uh, with minimal tracking error. You know, if there's a difference and there's underperformance, for example, most of that difference should be explained by fees. But what we can see here is that there's no underperformance. We've had a very strong period of time here where Christian Brothers has been not only a good performer, but more importantly, a consistent performer. And so none of the funds are on watch. Every single fund has met or exceeded its performance standard all the way back to December 31, 2020. And if we look at these results on the next page here, I'm going to highlight this middle column, excess and alpha. This is excess return relative to each fund's benchmark on a just straight up comparison basis. Did you beat the S&P 500, for example? Or excess risk adjusted performance, depending on how much risk the manager took. And we can see that all of these numbers in this middle column under 3, 5, and 10, they're black, which means that they're positive, which means that there's positive excess performance or positive value add created. We do see a couple of red numbers with negative numbers, negative alpha for the Catholic Responsible Investing Equity Index Fund. That's an index fund. The alpha of that fund should be 0 because it has a beta of 1. It's just the way those statistics work. So these figures are really not particularly significant. And the excess performance has actually beat the S&P 500. So this is very, very strong. The portfolio is doing well. The underlying managers are doing well. The finance committee is exercising fantastic oversight of the endowment. They're highly engaged, and things are continue to run very, very well for the endowment. Sorry I couldn't be there today. Have a wonderful summer, and perhaps we'll see you after sometime in August for the June 30 review. Cheers. God bless.